Good morning, good evening. Well, whatever it is in your time zone, happy Sunday. This is Rob Sin at CEO Technician on X, at Goldfinger on CEO.ca, at Goldfinger Capital on YouTube. And this is my weekly video for February 4th, 2024. And as you can see by the number of tabs I have open, there's a lot to get to. So I'm going to go fast. I'm going to be closing a lot of tabs. Feel free to pause, skip around, do whatever you feel like. Let's get started. So, great economic data in the US last week. Thursday, the ISM blew away expectations. Non-farm payrolls blew away expectations. Average hourly earnings blew away expectations. Meta, Amazon, Nvidia, Microsoft, incredible companies blowing away all analyst estimates. Stocks soar. At least if you open your Barrons, that's what you will see. 7 top takeaways from big tech earnings. Apple, Amazon, Meta, Zuckerberg, $700 million payday. Jobs report was a blowout, and disregard the seasonal noise. Big tech market capitalization. Everything is about tech here. They've got some article about real estate broker, the 6% brokerage fee, but whatever. Underneath the surface, everything is bullish in this Barron's. There's no mention of gold. No mention of gold. A little bit about oil and oil stocks, but nothing about gold. Nothing. Nothing about gold, gold mining. Nothing. Tech. Uber, Lululemon, cruise industry. Okay? Bullish, 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 bullish. So, CNBC, Barron's, Market Watch, Bloomberg, everybody's bullish. Everybody's gushing at the seams about tech. So that's the context. That's the setting as we enter this week, early February, the first full week of February. All Giga-cap tech, and this is a new term I'm using. There's large cap, but large cap is like 5 or 10 billion is large cap. 20 billion is large cap. 50 billion is large cap. Then there's mega cap, which is like 100, 200, 300 billion. Well, what about trillions? It's Giga-cap. Giga-cap. So Meta, Amazon, Nvidia, Microsoft, that's Giga-cap. I love this Jesse Livermore quote just to start the video. I never buy at the bottom, and I always sell too soon. So he was human, and basically that's everybody. Nobody buys at the exact bottom and sells at the exact top. And in fact, from a trading standpoint, all we're trying to do is catch a little bit of that middle, 30, 35% of that middle, and you're a world-class trader, as long as you can manage your losses well, right? And managing the losses is actually way more important than the profits. But as we get more skillful as traders, we become better at letting profits expand and grow and riding winners, right? But the first skill is managing the downside and really getting disciplined in terms of risk management. And then, like the master level trader, I use that term loosely, is able to really let winners ride and get some big winners. And all depending upon what you're doing. I mean, if you're short-term trading the E-mini S&P, a big winner might be getting 10 points on the S&P over like a 20-minute trade, right? That could be a big winner for a really short-term trader. If you're long-term trading junior mining stocks, maybe a 200% gain is a big winner, right? Because you're going to have so many 20% losers just because of the nature of the sector, that you need to be able to achieve those triple digit percentage wins to be profitable over the long run, trading, investing in junior mining stocks, right? So it's all depends on what we're talking about. You got to add the context. You cannot just generalize. Which market are you trading? What's your time frame? What's your objective? How much are you willing to risk to achieve those profit targets, right? So anyway, just a little bit of trading psychology and risk management talk to start this week's video. Well, now let's talk about market breadth. So JC Peret's all-star charts, he's turned bearish last week, right? And I had a post up last Wednesday or Thursday saying it's time to get more defensive. And he was also pointing out market breadth is narrowing. So it's not confirming the NYSE advanced decline line is not confirming the new highs in the S&P 500. So this is just the simplest way to look at it. We can analyze market breadth 10 ways to Sunday. This video could be 10 hours long just talking about market breadth, but we're not going to do that because it's freaking boring. This is just simplifies it, gets to the salient point, and that is small caps are declining, not making new highs, while Giga-cap, mega cap is leading the market higher, right? So if you're long Meta, if you're long Amazon, if you're long Nvidia, you're raking it in. You're having an incredible year so far in 2024. If you've got a broad exposure to the US stock market, like if you own IWM, you're not doing that great, not nearly as well, right? So this is leadership by a handful. And there's no arguing this at this point. There's no arguing the fact that without 5 stocks, the US stock market as a whole looks very, very different. Okay. So let's go through some of my bullet points. So the first one is about the jobs report. So Andreas Steno, he puts out some really good economic content, some macro content. And this is one of them. He dives into the jobs report and talks about just it wasn't as strong as it appeared on the surface. And obviously, intuitively, when I saw that 350K print or whatever, and the, revisions higher to previous months, I was like, this is ridiculous. This is such an outsized beat. Almost sure to be revised lower in March and April. I would be willing to bet quite a bit on that. But at the end of the day, the BLS jobs data has been so weird since COVID. So basically since 2022, the divergence between the establishment data and the household data continues to be widening. It's clear there's a lot of double counting going on, a lot of seasonal jobs, a lot of part-time employment, and full-time employment is not nearly as strong as all these numbers that we get that are thrown at us every month. Okay. And he breaks down, I'm not going to go through everything. You can subscribe to his research yourself. But the main takeaway is there was some weather, stuff, tricks going on that made the average hourly earnings look so strong. Basically, people worked fewer hours in January due to really bad weather across a lot of the country for part of the month, yet they were probably paid the same amount. So it's just is a freakish month that made the average hourly earnings look so strong. His takeaway is basically job growth is not reaccelerating and wage growth is not reaccelerating. And we're likely to see weak reports for February and March. And particularly, he seems particularly convinced that the March report will be very weak. So that will be interesting to see how this plays out. But all we had to really do was look at how the market traded throughout the session on Friday to get that people weren't fully buying this was such a blowout jobs number. Okay. And then Mike Shedlock, always good, pointing out that this non-farm payrolls report is just not nearly as strong as everybody's making it out to be. And really, full-time employment is only up 457,000 jobs since May of 2022. So while the non-farm payrolls are telling us up 5.77 million since May of 2022, it is less than 10% of that if you're just talking about full-time employment. Okay. Full-time employment, just 457,000. So the divergence is gargantuan here. So the data is not really giving us an accurate picture. The headline data, at least, is not giving us an accurate picture of the employment situation in the US. But I found this funny. Of all the sectors of the economy, utilities, financial activities, leisure and hospitality, government, blah, 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 the only one that was negative in January was mining. Mining was negative 7,000 jobs in January. And I think that really sums it up quite nicely. But the main takeaway, the jobs report was not nearly as strong as it appeared on the surface. Some tweets that also really I made note of. Full-time jobs. So here he's just pointing out, Larry is pointing out, full-time jobs remain in decline. Okay. And then here, millions of people are jumping from job to job to make ends meet, working part-time extra jobs, second job, third job. This might help to explain why the BLS in Washington revised lower the total 2023 payrolls by 1 million jobs. This also helps to explain the wide divergence between the household survey Challenger and NFP from the BLS. Okay. And yeah, and then this is Steno. I already talked about this. Useless job creation number. I think that sums it up. Okay. I think it's a very weird report. You really need to look at the details of it. There's more than meets the eye. Okay. So the dollar rose. So the euro dollar was down almost 100 pips on Friday. But, 107.88 opened the week at like 108.40. Not a huge move on net for the week. And also the 10-year basically, 4%. Yeah, it was diving the first 4 days of the week, and then it rebounded big on Friday. But still, it's about 4% on the 10-year. So 3.8, probably a little bit too low for now, but it's in a range. 3.8 to 4.2% range. It's been in a range since the end of 2023, and we're basically right sitting in the middle of the range. So, all the gushing and headlines about how good things are, euro dollars at 108, 10 years at 4%. Okay, not a big deal. One of Steno's other points was basically that He thinks that there's going to be room to make some dovish bets this week because obviously the market walked back the whole possibility of a March rate cut. Good chance that we've reached sort of a peak in the data of how good the data is going to get, and it's likely to weaken over the coming weeks, and the odds of a March rate cut might go up again, or May will become a virtual certainty again instead of being like a 60-40 or 65-35 thing. So the first thing I think about is gold miners, cyclical sectors. Okay, you want to bet on cyclical sectors. So here's the QQQ. It's one thing to say I'm not going to chase it here after this big a move, but it's a whole other thing to say I'm going to short tech here. I think if you're shorting tech here, you have no command of technical analysis whatsoever, and you're trying to pick up pennies in front of a freight train. Okay, this is not to be shorted. But look, QQQ was up 1.23% last week. IWM was down on Friday. While the S&P made a new all-time high, IWM was down on Friday, and it was down for the week. Not a confirmed breakout here. In fact, anything, you could try to make an argument that small caps just had a failed breakout. So there's a lot of little warning signs. That the breadth, weakness, the non-confirmation of the new highs in the S&P and the Nasdaq 100. There's a rotation going on under now where people are piling into staples, healthcare, pharma, sectors that are more defensive, right? Without the magic 5, it's not even the magic 7 anymore because we've lost Tesla and Apple last week. The magic 5, magnificent magic, whatever you want to call them, without Amazon, Nvidia, Meta, Microsoft, Google, we don't have the same stock market. It doesn't look anywhere close to how it looks right now. Okay, so those are some warning signs here, and just I look at all those Barron's headlines this weekend. I look at Market Watch. I look at Bloomberg, CNBC. Everybody's so effusively bullish. I don't know. It could be set up for a little bit of a rug pull coming here. Okay, it's hard to step in front of a freight train like that. I wouldn't be shorting Meta necessarily or Nvidia, but I don't know. Could try some other ways. Okay, this market is not completely as it appears on the surface. Okay, let's put that way. I mean, look at Nvidia. My God, what a move! And look at the market cap on this thing. $1.63 trillion. 87 times earnings. But look at the profitability metrics. Okay, we're going to talk about this later, but just incredible. Just absolutely incredible. Okay. So next up, mining. Okay, so let's get into mining. The problem with mining, illustrated in one chart. This is a good one. So this is copper. So this is the C1 cost of producing copper and concentrate each year, 2018, 2019, 2020, right? And then the total unit cost of a higher grade copper concentrate. Basically, the cost to produce a highly saleable premium copper end product is now $3.59 per pound in the top quartile, right? So the 25% highest cost, $3.59. The average annual price of copper 2023, $3.90. So notice 2020, you had a 207 cost per pound and you had a 280 selling price. So you're making roughly about a 30% margin. Now the margin is less than 10%. So costs have increased dramatically. Especially the jump from 2022 to 2023 is dramatic. It's very big. Copper was basically flat over that time period. So as costs spiked, the net selling price was the same, basically flat. And as you can see that there was a real nice sweet spot there in early 2021 where copper producers were really cash cows. And now only the lowest cost quartile is really making a nice margin. Everybody else is really sucking wind. Margins have contracted considerably. And that's the problem with mining. Just illustrated in one chart. You could say the same thing for gold, say the same thing for silver, same thing for nickel. It's even worse in nickel. Same thing in zinc. Right, the numbers are a little different, the percentages are slightly different, but the trend, the gist is the same. Okay, we're going to talk a little bit more about that in a bit. Gold rose last, so I want you to get this. This is a very important point. Throw my bias, my gold bull bias out the window. Let's just look at the facts. Earnings largely were terrific last week across the US. The economic data, based upon the way it's being reported in the media and by a lot of market participants, was blowout. It was spectacular. If I told you the economy is doing great, jobs market is fantastic, it's reaccelerating, corporations are hugely profitable, would you say that's bullish for gold, bearish for gold, or neutral for gold? That's for you to answer yourself. My answer would be bearish. Gold was up last week. Not a lot, but it was up. It wasn't down. It was up. Down 17 bucks on Friday, but for the week, gold was higher. Ended the week at $2,053.70. So we're going to talk more about that, but first, I'm going to talk about uranium. So first of all, I respect the trend here. I respect the uptrend, Cameco chart, the go-to uranium stock, $22 billion market cap. Basically, if hedge funds want exposure to uranium and the sector, this is the first place they look. This is the first place they go to. This is the most, liquid, biggest vehicle that they can get into. And if they want to take profits, if they want to trim it, if they want to be bearish on it, this is also the first place that they look to. I want to point out the topping tails here. 1, 2, 3. So 3 candlesticks in the last month with big notable topping tails on them. I also want you to just simply count the number of red candlesticks versus the number of green candlesticks. Okay. Simpler is better in technical analysis, but basically it's even. So it's like 8 to 8, red to green. Big topping tails up here above $50 per share. And then notice Friday's full-bodied bearish candlestick down 3%. So while Meta and Amazon and the S&P were ripping higher, Cameco was down over 3%. Okay, this candlestick setup and this price action against the context of what is supposed to be incredible news showing less supply of uranium U3O8 in the market is this should be a little concerning for uranium bulls. I'm not saying to short this market. I'm just raising some caution. These are some yellow, maybe slightly reddish flags starting to form here. Not calling it a short, just saying some signs of caution here. Kazatomprom, the biggest producer in the world, missed on its production, and basically saying that it has a sulfuric acid problem. The Kazatomprom mines are in situ leach operations, so they're not moving the earth. They're using acid to separate the uranium from the rest of the rock, the rest of the earth, right? And so this is sulfuric acid. Any in situ mining operation is going to use acid to extract the metal that they want. Sulfuric acid is also used in agriculture. And Kazatomprom is in Kazakhstan, the other side of the world, call it Asia. And there's supply chain challenges over there, okay? So their production is less than forecast. Should be bullish. Should be bullish. It was bullish on Thursday, but very bullish on Thursday. But I think there was a lot of profit taking there Thursday and Friday. So let's see how things go. Again, I say I respect the trend. Very strong uptrend. I'm not bearish on uranium bigger picture. I think this is a powerful secular trend, but could Cameco be in for a 10% drop back to near its 50-day moving average? Absolutely possible. So let's talk gold. Let's talk gold. There's definitely more than meets the eye in the jobs data, and those who actually spent the time to tear it apart and really understand it realize that it's kind of a false alert there on Friday. Not nearly as strong as it appears on the surface, and we're likely to see revisions the next couple of months, and also just weaker prints. But anyway, let's just take a look at gold. Gold continues to consolidate within a range. Last week, we got up to about 2,080 at the high. We settled just north of 2,050. The 50-day moving average is coming in about 2,039. So gold continues to be in a solid uptrend. And remember, gold is staying in this uptrend and consolidating near its highs for the last year, within the context of a Fed that still has not cut and has still not committed to when it's going to cut, and a U.S. economy that is supposedly very strong and resilient. Bullish. When a market that should go down based upon the news that we're being fed does not go down and actually stays near its highs, that is a sign of a bull market. There is no better sign of a bull market, okay? The COT data. So we're seeing open interest decline in both gold and silver, okay, in futures open interest. So when price is staying strong, staying well bid, while open interest in the futures falls and net speculative length falls, that is a caught buy signal. That is bullish. Okay? So gold and silver, particularly gold, are flashing a bullish caught signal here, commitment of trader signal. Gehring and Rosenzweig, very good commentary, February 2nd, 2024. Please subscribe for yourself and read it yourself. But they make a lot of really good points. And I'll just get to the sort of money shot. We believe a monetary regime change is imminent. We believe a new monetary system will emerge in which countries can bilaterally trade in currencies other than the US dollar, settling their current account imbalances using gold. China's closed capital account makes it impossible to repatriate excess renminbi. However, if current account imbalances were settled by selling renminbi for gold at the Shanghai Gold Exchange, then imbalances could be settled entirely outside China's closed capital account. China's ultimate goal is to weaken the reserve currency status of the dollar, yada, yada, yada. Read it for yourself, think about it for yourself, and then look at all the central bank gold buying data from the last couple of years. Look at China's gold buying since Q3 2022 and make up your own mind. Don't take my word for it, okay? So let's get to the crux of the matter here. Why does the mining sector of the stock market suck so much? You know, on Twitter, X, or other chat platforms, social media chat platforms, there's a lot of complaining. There's a lot of disgruntled investors. I made a tweet on, I think it was Friday. Yeah, it was Friday. You can see it's my pinned tweet. It's got like, I don't know, 55, 60,000 views now. And it definitely struck a nerve. It's just showing Meta adding 220 billion market cap Friday morning after it reported earnings Thursday afternoon. And in contrast to the entire global gold mining sector, which has a market cap of $277 billion. So forget about Meta's total market cap, which totally dwarfs the global gold mining sector. Just what it added on Friday was almost as much as the entire value of the global gold mining sector. If that doesn't hit you in the gut, as a gold bull, as a gold investor, as somebody who cares even the slightest about gold mining stocks, that's got to touch a nerve. That's got to be like, wow, that's incredible. So let's dig into, you know, like what might be going on here. So first of all, one of the best large cap mining companies in the world is Freeport McMoRan, FCX. Obviously, it's run from March 2020 to May 2021 was absolutely remarkable. I think $5 at the low, $50 or almost $50 at the high, 10x for a large cap, big cap company. That's incredible. That was an incredible move. That's the sort of move, value generation that makes a big difference to shareholders and investors. But since then, it's marked time. But go back to this and understand that in early 2021, Freeport had peak margins, right? So it had a margin expansion event, a very significant one during 2020 and 2021. And investors piled into the stock. They loved that margin expansion. If a mining company can show sequential margin expansion, profitability expansion, growing earnings, free cash flow generation, that is the mother's milk of share price gains. So forget about all the nonsense that is spewed by the tinfoil hat gold bugs, gold and silver bugs, which I am not one of, by the way. Even though I'm bullish on gold, I don't wear a tinfoil hat. There's a distinction there. However, the tinfoil hat wearers will say it's a conspiracy of gold price and silver price suppression, and in turn, the miners are suppressed, right? And they won't actually look at the financial statements. They won't actually understand that big money pension funds, sovereign wealth funds, hedge funds actually look at company financials. They look at what the companies report and how profitable they are. And most importantly, the trend in profitability or unprofitability, right? So Freeport has marked time for the last 2.5, 3 years. It's gone nowhere. But that was after a 10x move in just over a year in 2020 into early 2021. So Freeport went from powerful uptrend, stage 2 markup phase, to a consolidation, topping process, downtrend, bottoming, consolidating again, okay? My bet is, and I spoke as much at Metals Investor Forum in Vancouver last month and Kitco News and multiple other speaking events. My bet is that during 2024, copper will move up appreciably, so 15, 20%, something like that. Freeport will also break out. It will break this 2022 high. We will see Freeport above $50 a share at some point in the next year. Okay, so that's my forecast. As usual, strong opinions, weakly held. So that's the first part. BHP, another mining stock that outperforms many of its peers. It also happens to be the largest mining company on the planet. But even despite, yes, it's in a long-term uptrend. It's actually just came off an all-time high at the end of 2023. Look to the left in the chart. It's gone nowhere in the last 2 years. It's been marking time. The whole mining sector has either just been flat or in a major downtrend for the last 2 years, all depending upon which company you're talking about. Freeport and BHP are the cream of the crop, the creme de la creme, the best in the world. If we go down the food chain, we'll see plenty of mining companies down 30, 40, 50, even 60% in the last 2 years, right? Agnico Eagle, creme de la creme in the gold mining sector. But unfortunately, it's a gold miner. And look at what it's done recently. It's in a downtrend. Look to the left on the chart. Also done nothing in the last 2 years. And actually, if you go further back, let's go further back. It's in a downtrend since its 2020 peak. But also, look at the move it had in 2020. From 30 to 80 for a very large cap company. You're talking about 15, 20 billion market cap company had a, almost 3x move, right? But it's in a downtrend along with the rest of the gold mining sector. They're all in a downtrend, especially the last couple of years. So why does the mining sector of the stock market suck so much? Let's have a look. Kinross Gold. It's like the 4th or 5th, 6th biggest gold mining company in the world. So let's just assume it's the 6th. Its market cap is 6.75 billion. That's, I don't know, I guess it's large cap, but it's barely large cap, especially in 2024. Tiny. Cash per share. They've got like 400 or 500 million in cash. It's not a lot. For a big company, that's not a lot. Now, here's the important part. Return on equity, 4%. 4%. Return on equity or gross margin or profit margin, like these are, if you only could look at a couple of financial metrics, these are the ones that you'd want to look at in any company. This is finance, stock market valuation 101. The return on equity is 4%. It's like that's like the yield on a 10-year note, 4%. Right? But this is a risky stock, a cyclical risky stock. And it's only generating a return on equity of 4%. Profit margin, 5.83%. So the profit margin is the net income after taxes and costs of debt and everything is taken out. The final profit as a percent of revenues, 5.83%. Okay, let's look at Barrick Gold. Profit margin, 0.52%, not even 1%. The return on equity, 0.25%, a quarter of a percent. So the return on equity is a quarter of a percent, yet they're paying a 2.61% dividend. They're paying dividends out of cash, right? They're paying dividends not out of profits. They're paying it out of their cash stores, their treasury. And yeah, they got a little bit of debt, not a big amount, but they got a little bit of debt, right? Kinross got more debt. Okay, let's look at Newmont. Return on equity, negative 4.16%. They lost money last year. Profit margin, negative 7.49%. So Kinross, better than Barrick, and Barrick, better than Newmont. Hilarious. But Kinross is better than Barrick and Newmont on profitability metrics, but it trades at a forward PE of 13.8. Barrick trades at a forward PE of 14.5, and Newmont trades at a forward PE of 15.8. So Kinross is actually the best one of the three in terms of profitability metrics, but it trades at the lowest multiple. It's punished for its size, and it's punished because it has more debt as a percentage of its equity than either Barrick or Newmont. So this is just basic finance stuff that you guys should definitely understand, hopefully. And if you don't, well, now you do, okay? And here's Agnico. Oh, hold on. Look at Agnico. 3.29% dividend, only 0.11 debt to equity. So less than Barrick, less than Newmont, and less than Kinross. The lowest of the four debt to equity. And return on equity, 14%. Way better than its peers. Profit margin, 40%. Agnico is the shining superstar of the gold mining sector. And performance in the last 6 months, basically flat. Performance so far in 2024, horrible. Down 11.3%. What's wrong with Agnico? It looks good here on the surface. Why is it performing so poorly so far in 2024? So actually, I'm going to ask this question to my viewers. What do you know about Agnico and why it might be performing so poorly so far? Oh, look at Newmont, down 16%. Look at Barrick. Wow, the gold miners are horrible so far in 2024. But look at the gold chart. It's not even really moving much. It's only down a little bit. Wow. So I was kind of setting this up but I would like to hear what you have to say. But clearly, it was lowered guidance from Barrick that set the stage for this poor performance. So yeah, gold's down a little bit. Gold's down like 2% so far in 2024. So if gold's down 2%, maybe gold mining stocks should be down 4 or 5%, but not 15%, not 11%. So the market is bracing for bad reports from these companies in 2 weeks. So Agnico reports February 15th, Newmont reports February 22nd, Barrick reports February 14th, Kinross reports February 14th. So the next 10 to 20 days, we're going to get all the gold miners reporting earnings. The market has sold them down in advance of these earnings. They're bracing for bad reports, okay? So this is actually an interesting setup from a contrarian point of view because of the really poor performance in the last month. Even the standout star of the gold mining sector, Agnico, AEM, has been thrashed in the first month of 2024. P's, it's at 9, but clearly they're expecting earnings to not be nearly as good in 2024 because the forward P is now 20, right? EPS trailing 12 month $5.32. EPS next year $2.45. Okay. I'm not an expert on Agnico and all their operations and why that is exactly, but what I find interesting here is Newmont, the only gold miner in the S&P 500, by far the most hated gold miner on the planet. And actually, there's a lot of things to like about Newmont here. Okay, so first of all, the first thing to like about Newmont is the fact that it's sold off so much and that it's at support. So from just a technical standpoint, it's held support at $34 a share. And actually on Friday, against that blowout jobs number and gold down $30 early in the session, it had a failed breakdown below 34, but closed back above it at 34.41. And actually you're seeing the MACD, when a stock bottoms and starts to hold a big support level and then start to turn up, you see this MACD bull crossover. So we're starting to see that in Newmont, the MACD bull cross and the non-confirmation in the relative strength. So even though price made a new low for this down move, the relative strength did not. It was well above 30, as opposed to in mid-January, it was well under 30 when Newmont first tested that $34 level, right? So the technicals look pretty good. And also, the stock has performed so poorly in the last year, down 36.5%, that basically it's lost 20 billion. It might be actually a little more than 20 billion in market cap in the last year. It basically paid 20 billion for Newcrest. So it acquired one of the other top 5 gold mining companies in the world last year. And its performance has been so bad that it's already shed the entire market cap of its acquisition. So I think just from a lot of different angles, both technical and fundamental, and sentiment, this is a very interesting opportunity here in Newmont at $34 a share. Okay, and just going through their deck, which they're going to update in 2 weeks, when they report earnings, so this will be stale very quickly. But the portfolio of assets is not going to change in the next 2 weeks, right? So some of their acquisitions, Cadia in Australia, Red Chris and Brucejack in Canada and the Golden Triangle, they have opportunity here to optimize these operations and prove that the acquisition of Newcrest was a smart move. Also, their biggest and best mine basically is Penasquito, in Mexico, and that had a very bad performance in 2023 due to a mine strike. It seems like that's all smoothed out now, and there could be an opportunity. Hold on, let me get to the right slide here. Sorry. There's an opportunity for them to beat to the upside at Penasquito. Okay. The market, one of the reasons why the market sold off Barrick and Newmont was because of Nevada, Carlin, Cortez, Turquoise Ridge. But that, in theory, that should be priced in at this point, okay, because they've been selling the stocks for the whole month of January. So let's see. Let's see. They talk a lot about optimizing some of these big mines, autonomous haul fleet. They talk a lot of cost cutting, a lot of mine operation optimization, optimized mill performance, $300 million of synergies, right? A lot of talk about getting costs under control in this presentation. Obviously, it's a presentation, it's a marketing exercise to some extent, but they're also setting market expectations, so they don't want to be terribly overly optimistic, right? I think this is a tremendous opportunity in Newmont to be a contrarian and bet on the best, the strongest Fort Knox balance sheet in the gold mining sector. So cash, $3.2 billion in cash. That's a very impressive treasury. Their weighted average cost of debt, there's no other company in the sector that could come close to this. And that has a lot to do with the fact that they are an S&P 500 component. But a gold mining company with a 4%, they're paying the 10-year note yield. The cost of their debt is what the U.S. Treasury borrows at. Okay. So a lot of people talk about how Newmont is overpriced. It trades at too high multiple. I disagree. It's trading at 15x earnings. Yeah, that's forward, but 15x is a very low multiple to pay for Newmont based upon history. If you look at the average multiple that it's traded at the last 10 years, 15 is very, very low. So this is a tremendous contrarian opportunity to get what is, in theory, the biggest and the best with the most tier one operations in the entire sector. Okay. And I mean, there's basically, a handful of mining companies in the world that have an A rating by any of these, ratings agencies, and Newmont is one of them. So there's a reason why it has traded at a higher multiple. There is a reason. It's in the S&P 500. It has the largest number of tier one assets in its portfolio. It has one of the strongest balance sheets, yada, yada, yada. It's based in the US, right? So you're getting it at a historically low valuation. And I'm just gonna say, look, I'm not looking for Newmont to double. Give me 20, 25%. I'm happy. But I like it here. You've got a juicy dividend, almost 5%, dividend yield here. I think the dividend is safe. Let's see. This is an opportunity for Newmont to actually not disappoint a significantly lowered outlook and a stock that has been punished relentlessly in the last couple of years. Okay, so there's my pitch. There's my pitch. Please do your own due diligence. It's your money and your responsibility, but I like it here from a contrarian standpoint. So now let's explain why the mining sector sucks so much. Look at the financial metrics of mega cap, giga-cap tech. Apple return on equity, 154%. Gross margin, 45%. Profit margin, 26.16%. And that's on a 2.8 trillion market cap. Incredible. Incredible. Meta, 28% return on equity, 80% gross margin, 29% profit margin on a $1.2 trillion market cap. Incredible. Microsoft, 39% return on equity, 69.75% gross margin, profit margin above 36%. You don't need to look farther than this, okay? Here's why mining sucks, and here's why Giga-cap tech is eating everybody's lunch. All this green, all this growth acceleration, incredible profitability. 69% return on equity from NVIDIA, 70% gross margin, 42% profit margin. So nearly half of NVIDIA's sales translate into bottom line after tax net income. That is freaking incredible. That is incredible. And look at the profit acceleration, 269%. And even next year, they're slated to grow 70%. I mean, that's it, guys. That's all you need to look at. You treat shareholders well. You knock it out of the park like this, your chart's gonna look like that. Bottom left to upper right. Mining industry, especially gold mining, has just not done it. Okay, they've disappointed time and time again. So investors, shareholders are fatigued by the gold mining sector at this point. From a contrarian standpoint, that is when you want to step in. But the question is, they still need to deliver, produce results, perform. Let's see what this sector can do in 2024. Okay, if gold price stays at 2,050, if it's stable at this level, these companies should be up on the year. Let's see if they can actually perform. If gold performs, if gold's up 10%, if gold's above 2,200, gold mining sector should be one of the best performing sectors in the entire stock market in 2024, in my assessment. Okay, in my assessment. So Newmont, we talked about Newmont. Let's get rid of that. We're getting down to the end here. Talked about Agnico, by far the best performer in the gold mining sector. And still, its performance has been pretty lackluster, right? It's just been a tough sector, guys. So I like Newmont. I like Freeport. I also like IM Gold, IAG. So from a technical standpoint, remember, like, this is a tiny gold miner. This is like barely more than $1 billion market cap, right? But they're about to put into commercial production Cote Lake. Cote Lake is a gold mine for a super major. It's a gold mine that would fit in Barrick or Newmont's portfolio very nicely. It's that big, okay? You're talking about a mine that, in theory, based upon forecasts, should eventually produce 500,000 ounces of gold a year. That's a mega mine. That's a Newmont kind of size operation, right? But it's in the asset portfolio of a tiny miner that is like 2%, 3% the size of Newmont, right? So I believe this is an opportunity. Now, they don't own Cote Lake 100%. They had to give up a chunk of it to Sumitomo to complete construction. But they told us at the end of last year, actually they told us a couple weeks ago, that it is on time and on budget now. They expect to officially declare commercial production in Q1. So it should happen this month or the next. And I believe that this big consolidation under this blue horizontal line is about to come to a climax here in the next month, and we should get a breakout above the 270 level at some point here soon. So that's my bet. If it breaks out above 270, we will see IAG trading above $3 at some point here in 2024. So we're under 250 right now. So I see 20-30% upside here, even with the gold price treading water 2050. If we get the ramp up going smoothly at Cote Lake and gold rising, it could be a nirvana scenario, and then you could be talking about big returns like $4 a share. Okay, but I don't want to set that as my base case. I don't want to make that the expectations. Like I expect a 60% move in $1 billion company. No, 20 to 30%. That's what I'm looking for here. And I would be quite happy with that. I am long IAG. And now we're going to get smaller cap. So let's move Victoria Gold. So this is borderline mid-tier. This is like in between the junior and mid-tier, because I think of junior producer, I think of like 100,000 ounces or 50,000 ounces. Mid-tier producer would be like 200,000, 300,000, 400,000 ounces. Victoria Gold VGCX on the Toronto is about 170,000 ounces now. They want to be a 200,000 ounce a year producer, but they haven't reached that milestone mark yet. But hopefully they're on their way to that. So again, this is an opportunity for a gold miner that has had some challenges in its first few years of production at Eagle to perform, to deliver, to do what it says it was going to do, right? To keep its word to its shareholders. Victoria has that opportunity. We'll get a production update from them this month. I expect them to deliver on their guidance as they said they would in November. And I like the chart set up here. This is a double bottom. This is an ascending triangle. Okay, so let's break out from the ascending triangle, and then let's break out above the key resistance level around 730 a share, break back above the 200-day moving average, and let's get back to $9 or $10. So I see 50% upside potential in Victoria over the next year. Where am I wrong? Well, if you're a really short-term trader, you really want to keep your losses to a minimum, you put a stop under $6, nice round number, and that's also the support from January. If you've got a little more rope, just put it under $5. So you're going to have to risk 20% here to really give it some room. But this double bottom, support, that is big, major support. It should not break back under that, okay? For it to break back under that, there would have to be some real operational problems up in the Yukon, and also probably a falling gold price. Okay, so that's the risk. 20% max downside, 50% upside. I like the risk versus the potential reward. Long Victoria Gold, long IAM Gold, long Newmont, the worst gold mining company, the biggest and the worst. Long all three of them. Okay. And then we go into junior land, tiny little junior land. I don't have really anything new about American Eagle Gold, but a guy named Nate Smith on Twitter has been putting out some great content on this one. A lot of analysis of the IP data, the drill plan map, drill hole section maps. He sees a lot of potential here for the resource to grow at AE's NAC project in BC. I've made it no secret that I like the stock. I've made no secret throughout 2023 that I like the stock. I still like this stock. Yes, it's higher than it was before, so there is more risk in theory. So please be aware of that. All you gap people, gap players are going to point out to me, oh, there's a gap of 27 cents. It's going to fill that gap. There's too much downside. There's also something called a breakaway gap. So this one has the potential to be a breakaway gap in AE. And those are the most bullish gaps of all, the ones that don't get filled. Just saying. Tech's got almost 20% of this thing. Tech is a big global copper producer, and NAC appears to have a lot of copper, something that they want. So one to continue to follow in 2024. And then Hercules Silver. So made a lot of content about Hercules on my Substack. I'll put the link in this video to my Substack. Please subscribe. Putting out A lot of content on there lately. So BIG, which is Hercules Silver, had a nice run there after dropping on January 22nd after reporting whole 26 assays. But notice that was just a very short-lived blip that actually led to a failed breakdown and a very nice run. So it ran from 65 cents, the low of that morning, January 22nd, to above $1 last week. Basically a 50% move. That's a nice move. And then it just a little pullback on light volume there Thursday and Friday. But the breakout line is at 91 cents. So it's holding, basically pulled back to the breakout, right? So the technicals look fine, look good to me. Cooled off a little bit there for sure on Thursday and Friday after a nice run, but that's par for the course. 3 steps forward, 1 step back. I'll take that all day long. Nothing has changed here with my view of this one. Long and strong Hercules Silver Corp, which is soon to be called Hercules Copper Corp. And that's another theme I think we're going to see a lot more of in 2024 is the big gold companies, Barrick and Newmont, the top two, adding more copper assets to their portfolio, copper production potential to their portfolio. And I think that was also one of the reasons why the Newcrest acquisition was made, and also probably why Barrick pulled the trigger on a $35 million investment into Hercules Silver to get a 15% stake in this one. And remember, Barrick paid $1.10 for a big pile of shares, over 26 million shares, and then they paid $1.05 for another 7 million shares. So at 92 cents, you're getting a discount to what Barrick paid for most of its position in Hercules. All right. So I'm going to leave it there. Hope you guys have a powerful trading week ahead. Thanks a lot for tuning in. And if you found value in this video, please hit the like button, subscribe to my YouTube channel, and check out the Substack. Until next time.